Good morning, everyone. So this is going to be the last week of discussion because next week is going to be a dead week, right? And next week, so Monday we are next week Tuesday we are going to have a review, and then Thursday we are going to have our final, right? And this week, so what are we going to do? So we are going to finish this chapter, and we're also going to discuss a few things in the next chapter. So that's going to conclude the discussion for this semester. So let me quickly walk you through what we learned so far for this semester, for this chapter. So this is a chapter we are trying to understand money, banking, and monetary policy, right? As we said earlier, so usually we rely on fiscal policy and monetary policy to help to stabilize the economy. We have learned how fiscal policy can stabilize the economy. And then so in this chapter, so the goal is, so we try to understand how monetary policy can reach the same goal. So there's a question from the students. Yes, we're going to have a pop-up quiz. So we are going to talk about that later, all right? All right, so money, right? So monetary policy. Now, so far, what we have learned? We have learned what is money. Right, so essentially money is any financial assets that has been commonly accepted as a medium of exchange. So money, so you need to serve at three functions. So it's a medium of exchange, it's a unit of account, and a store of value, right? And then in human history, so we have used different kind of things to serve as money, right? In some extreme case, so the secret in prison, and then some island. So we have these big stones. So that's been used as money, right? And then so what is money supply? Essentially is the currency in circulation and other liquid assets. Okay, so that's money. So now let's just go to the slides we have went through so far. So money. So this define money, and then right. So here. Oh, by the way, so there are a bunch of definitions you must keep in mind, right? So currency in circulation, those are cash held by the public. Checkable bank deposit, those are bank account on which people can write a check. So in a sense, it's very liquid. Money supply is the total value of financial assets in the economy that are considered as money, right? And then so we talk about three functions. Money must serve: medium exchange, store of value, and a unit of account, right? So we also expand, so what do those function means one by one, right? Okay, make sure you understand that. And okay, so what else we talk about? Yes, so we have talked about three type of money. Start with commodity money, right? So those are goods used as medium exchange, but this good itself has intrinsic value. Like this background picture shows. And so make sure you understand so why this commodity money eventually has been phased out in our society. Largely because it is not convenient. It is not convenient in terms of store value. Also, it's not inconvenient in terms of medium exchange. Right? And then so later stage of a human society, we develop commodity-backed money. So now the money itself has no intrinsic value, like this piece of paper. And however, so this piece of paper is guaranteed by certain amount of commodity. And then the commodity itself has intrinsic value, right? But then, so this commodity-backed money is limitation. In the sense, so if the government want to increase money supply, and then so the government or central bank must increase their preserve of commodity, or so they need to acquire the same amount of commodities to match with the increase in money supply. Okay, so that's put lots of limitation on the policy the government can carry out, right? Now, so in modern economy, we move to fiat money. So similar to commodity-backed money, the money itself has no intrinsic value. But one step further, so this money has no commodity back. The only things that justify the status of this money is a reputation from the government, right? Okay, and then so we look at monetary aggregate. So this is what we heard from news, M1 or M2, or usually this is what the government, what the central bank usually is going to control, right? So M1 and M2 are two definitions of money supply, right? So those are two most liquid form. So actually, so in reality, we have other forms of money supply, right? So now let's just look at what is M1 and M2. So maybe just look at here, it's easier. So M1 essentially includes currency and a checkable bank deposit. Those are most liquid form of money. What's M2? M2 includes M1 and then so plus other less liquid but are relatively liquid than other things that are not liquid. Like think about the gold, right? We talk about in the practice question. Okay, so make sure you understand. So what is M1 and what is M2, right? Okay, now this is money M1. So we have a look at these practice questions. The last things we discussed in last class was the following. So how the bank generates money, right? And so also from this money generating process, we can see some risk or some potential problems lies in our banking system or financial system. Okay, now let's just look at this example to understand so how bank or banking system generates money, right? Also from this example we can understand so why there's some risk in financial system and why the central bank want to regulate this market, right? So now let's look at here. Maybe just go to that directly. Go to that example. So just bear me with a second. All right, so look at this example. So in this example, where we start? Right. So we have a person in the economy. Okay, so Silas, that's what is name in this example. So Silas has $1,000 of cash. So before we have banking system involved, and then so all the money supply we have is $1,000. Right, so this is where we start. Now, as we said, so we enters in a modern economy, right? And then Silas decide to deposit his money in the bank. Now, if we look at the first row, okay, now, so this is where we start, right? So Silas has $1,000 in currency in circulation because it's cash, no bank, and then money supply is 1,000. Now, so Silas decided to deposit his money in the bank. Now go to second row. So Silas has $1,000 of bank deposit. Okay, before the bank do anything, so the money supply will equal to the bank deposit if the bank do nothing. Right? So essentially, so the money supply changed from money in currency in circulation to deposit to bank deposit. All right. Okay. Now, however, the bank, if they do nothing with this $1,000, bank is not making any profit, and then the bank is not going to survive, right? And then so what the bank is going to do, so the bank will lend out those $1,000 of deposit, right? And actually, so in reality, it's usually, so the bank is going to charge higher interest rate for the loan, right? And then, so once the bank lend out this money, so like in this example, okay, Maya take loans from the bank, and then you can see the banking system immediately generates new cash or new money, right? Okay, so you can see now the money supply will change from here, so 1,000 to 1,000. So that is belongs to Silas. Silas cash becomes bank deposit. Also, so we have Maya. So Maya have $900 of loan, and then so this person is going to withdraw the cash from the bank. Now we have money supply of 1,900, right? Actually, so here, so this 900, so was a loan taken by Maya, and Maya paid to N. All right. And then so what N is going to do, so she is going to deposit money in the bank. Now go to the third row, right? So now we have two deposit. 1,000 comes from Silas, and then so another 900 comes from N. Okay, so this is 1,900. There are two deposits. One is from Silas. The other comes from N. Okay, so 1,900. Okay, so now the bank is going to make additional loans. Where the additional loan coming from is because N has $900 of deposit. And then the bank is going to make loan based on N's deposit. Right, so 810 is slightly lower than the deposit N made. And this 810 goes to whoever takes a loan, right? So withdraw as a cash or just open a new account. So now you can see the money supply increased to 2,710. All right. So this is how the banking system can generate money. So essentially, because the bank attract deposit with the deposit, and then so they are going to make new loans with new loans, and then the other person is going to have cash, or the other person is going to have a bank account. Right? Okay, but from the discussion here, so there are two things we learned. Number one, the banking system can generate a lot of new money. This is number one, right? And the size of the money supply the banking system can generate depending on the ratio between the size of the loan and the deposit, or the reserve, or it's depending on the reserve ratio, right? Okay, this is the first thing we learned. And secondly, so from the discussion, so we can see there are potential risks exist in the banking system. Now just look at this table. So you can see Silas and N both has a claim on the bank. Okay? Or in other words, the bank has liability over Silas and N, because Silas, so in some sense, so he has a contract, or he has a certificate from the bank says, so you have $1,000 deposit in my bank, you can come to my bank anytime, withdraw cash. The same happens to N, right? N, so she has $900 of deposit or certificate, says that she can come to the bank anytime right? Now, just imagine if both Anne and Silas come to the bank, says, so I need my cash. Okay, so I need my cash, or so, and then so the total cash they need is going to be 1,900, right? And then where does the money will coming from so that the bank can serve these two customers? So in the ideal work, so the money is going to come from where? Coming from first, because remember, so the bank used the money to lend out, right? So they lend to lend to whom? Lend to Maya, and also they lend to some other person, and so on and so forth. And plus they have some reserve, right? So by the way, here we can calculate the reserve. The reserve we have is 100, and plus, so there's a $90 of reserve right here. So this is 800 out of 900. So this is 900 out of 1,000. Right? So what that means? So when Silas and Anne come to the bank, says, okay, so I need our cash. The total they request is 1,900. And actually, so the bank is sitting on $190 of cash as a reserve. So which is 190. And in order to satisfy these withdrawal claims, so in the ideal work, they can call Maya, says, okay, so you took loans from me, and so we have customer need cash. Can you just come to the office, just pay off your debt, and which is $900. And similarly, so they're going to call the other customers who took loans. If that's the case, now we can calculate, right? So 100 plus 90, so that is the reserve they have, the cash they have, plus 900, which is the loan Maya took, plus 810, which is the second loan somebody else took. And this add up equal to 1,900. So in the ideal work, so whenever someone come to the bank, want to withdraw cash, the bank has some reserve, plus they can call their borrowers, and the borrowers can immediately pay off their loan. If that's the case, and then so we are safe. But certainly this is not the case, right? So the loans we take usually is a fixed term, right? Like say for example, so we finance our house with a mortgage. This is like 30 years, right? So the bank calls want us to pay off our debt, but usually this is not going to happen, right? Because we have a contract, so it's going to be 30 years. And even you have a credit card, so usually, so there's a certain period for you to pay off your debt, right? I hope you see the gap. What is a gap? The gap is if every depositor, savers come to the bank, request for money withdrawal. And then so you can see usually, so the bank has lent out or invest their money into something not perfectly liquid, in the sense they cannot get the money they need immediately, like the loan, right? So that means, okay, so if all the depositors come to the bank, and most of the time the bank don't have enough to satisfy the need of their customer, so that creates some problem. Actually, so the worse the problem when the loan went sour, right? Just say, for example, so these borrowers default, right? So then, so definitely, so the bank has no money to satisfy the need of their depositors. Okay, so from this discussion, you can see, so there are inherited risk or fragility in our modern banking system. But then someone may say, okay, so why we need a bank in the first place? The answer to that is the bank actually work as a bridge. It's like here. So Silas, in this simple economy, Silas doesn't know Maya or cannot trust Maya. Right? In reality, it means, okay, so if you have $1,000, it's going to be, in general, it's going to be difficult for you to find out someone who you can trust and you can lend your money to them. So the bank actually work as a middleman, so it's going to channel the money from those who have to those who have not. Okay, but then, so because the business model of the bank, so we can see there are inherited risk or fragility. Right? Okay, and then from the discussion, I hope you also can see, so what we can do, I mean, as a central bank, so we can control the risk or we can fix the potential risk. Okay, and so here, from this discussion, so first, now we can go to the previous slides we missed. By the way, here, so they just kind of summarize the situation. Okay, so financial institutions operates as part of a fractional reserve banking system. Right. So when you deposit money in the bank is required to hold part of it in its vault as cash. Like in the example I just showed, so Silas deposited $1,000, and so the bank only leave aside $100. Okay, and so why they want to do that is because if the bank put all the money from the savers in their vault, they're going to not making any profit. Right? But however, if the bank only leave a fraction of the saver's money in its vault, and then so that's going to make the saver nervous. So when the saver needs money, so it may not be the case, the bank can immediately gather enough money to pay the saver, like I just explained to you, right? Because usually the money was invested in some risky business. So the risky business may go sour, and also so the risky business may not can pay off the debt immediately or may not able to pay off the debt as the bank requested. Okay, but that's going to make the saver nervous, right? In the worst case scenario, so all the savers will come to the door of the bank and want to withdraw the cash. So that's going to squeeze the bank, and then so we are going to have a bank run, right? Okay, to avoid these things to happen, and then so we have some regulation. The first is called deposit insurance. Okay, use the example we just discussed. Silas deposited $1,000, and then the bank is required to buy insurance just in case the business go bust, and then so this insurance is going to pay off Silas. Okay, and actually, so the regulation says so all deposited must get insurance up to $250,000. Meaning, so if you have a deposit, okay, so the first $250,000 will be safe. But certainly, so this insurance is going to be paid as a cost, right? Capital requirement. So they just make sure the bankers or the owner of the bank, they are more responsible in choosing their investment project, right? Like the example I just showed you. So if they just operate the saver's money completely, and they may not have a strong enough incentive to watch the money carefully, right? They may invest in some very risky business so that they can have higher return. But then what happens if those business went bust, right? So this is a capital requirement. Now third, there's a reserve requirement. So these are rules set by Federal Reserve that determines the minimum reserve ratio for a bank. Okay, like the example we just discussed, Silas deposited $1,000. And then the bank is only allowed to invest up to $900 and must leave aside 100, which is 10%. Put the money in the central bank. Right. So the last regulation is called discount window. So this just in case the bank really in trouble, and then the bank has a place to ask for help. It's like a last resort. Okay. So this is a place where central bank can lend money to a troubled commercial bank. Right. So those are the banking regulation. And again, so those banking regulation coming from the inherited risk we have seen in the financial system, the banking system, right? Okay, so we have learned this banking system, how the banking system can create money, and at the end, so the money supply can be generated by the banking system will depending on the reserve ratio, right? Which is going to calculate by this equation. Okay, this is similar like a multiplier as we learned earlier. There is a related concept called excess reserve, which is a bank's reserve over and above its required reserve. Okay, what that means? $1,000. If the required reservation is 10%, meaning so the bank must leave aside 100. It could be the case the bank leave aside 200, but in a normal time, so the bank won't have no incentive to do that, because this additional 100. So because 200 minus 100, there's additional 100. This 100 is called excess reserve. Won't bring any profit to the bank, right? So the bank has incentive to extract all the possible profit. Okay, so in normal time they won't hold any excess reserve. Right. So we have seen this practice question. Right. So now let's see. We also have learned these practice questions. So here just summarize the money supply and money base. Right. So start with money base. So money base, we have currency in circulation, and then plus the bank reserve. So that's the basic of the money. But what is money supply? Money supply, so actually here is M1, so most liquid. Okay. So money supply equal to currency in circulation plus checkable bank deposit. All right. So this is M1. So in reality, the money supply, how the money supply is determined, is more complicated than our simple model just suggests. It not only depends on the reserve ratio, so it also depending on so how much cash we choose to hold or go back here, right? Here, so this money supply largely depending on, so say for example, so if we receive some money from the central bank, how much we are going to keep as cash, right? So if we keep everything, just think about extreme case, if we keep everything as cash, and then so actually so we won't have any checkable bank deposit, right? Because everything is going to be show up as cash. On the other hand, so if we we hold nothing as cash, and then this part goes to empty, so you can see the money supply is going to be much larger, right? Okay. So now summarize this part. So money multiplier is a ratio of the money supply to the monetary base. Right. So in normal time, the U.S. monetary multiplier for M1 is between 1.5 and 3.0. It's much smaller than 10. Where the 10 coming from? Because this 0.1 is 10% reserve ratio. So this is what happens in our real economy. And why we have a money multiplier much smaller than this hypothetical money multiplier. This is because people hold significant amount of cash, which reduce the bank's ability to make deposit. And also this money multiplier will be different from country to country. Like say, for example, if you go to Japan, okay, so Japan is a country that largely relies on the cash. Now, even though their economy is very advanced, and even though their technology is pretty advanced, okay, still they rely on cash for some technical reason and for some economic reason, right? Now, the other things we are going to discuss, we are going to learn in this chapter is going to be the Federal Reserve System. And we're also going to learn how the Federal Reserve System can affect money supply. Right. So currently, the chair of the Federal Reserve System is Jay Powell. Right. So he is a person who is going to charge the financial regulation. And as a central bank, Federal Reserve is going to oversee the regulation of the bank and control the monetary base. But what is the Federal Reserve's goal? So they are trying to strike a balance between, like we talked about earlier, the need of the worker and the price stability. What is the need of the worker? Is unemployment, low unemployment. What's price stability? So we make sure we don't have fluctuation in price level, right? So here just give you a map of different Federal Reserve Bank, right? So in the middle, this is the board of governor, that's in DC, and then we have 12 districts. Okay? Like here, we belong to the Kansas City Fed, right? So this Kansas City Fed, this Federal Reserve Bank is going to oversee this region, this yellow region, right? Right. So now let's see how the Federal Reserve Bank works in reality, or what they do. Okay. So the Federal Reserve Bank, the main things they do is just change the money supply, right? And so now let me just show you how they change the money supply. Let me skip this part. So to understand how the central bank, which is a Federal Reserve Bank, can affect money supply. Now let's just look at Federal Reserve Bank's assets and liability, or just look at their balance sheet. Okay? So their balance sheet will be similar to a commercial bank. Now their liability is their monetary base. Right? So this monetary base include currency in circulation and bank reserve. So how we understand that? So currency in circulation, essentially, the central bank, they print out money. And then the money will distribute or will be obtained by households or business. But then remember, this is going to be a liability in the sense whenever the households or business come to the central bank, so this currency must be redeemed. Okay? So in reality, like in old day, it can be redeemed with a certain amount of precious gold or silver. Now in modern days, we don't have commodity back, but then with the currency, so you are entitled to do any financial transaction you wish, right? So in that sense, this is a liability. And similarly, so the commercial bank have some reserve in the central bank, right? So it's like central bank. Sorry, it's like commercial bank has some deposit in central bank. Okay? And similarly, currency in circulation, you can think about individuals has an account in central bank. It's like deposit. So that's their liability. Now, with this liability or with those resources they attract from individual and from commercial bank, the central bank can invest. What they invest, usually they buy treasury bill, which is government debt. Right? Okay, now given this account for central bank, we can see how the central bank can increase money supply. Okay, so usually the way they increase money supply, now let's go to here, goes here. Okay. So usually the way the central bank increase money supply is by purchasing treasury bill. Okay, now let's see how this works. So first of all, Federal Reserve, they buy treasury bill not from Treasury Department. Instead, they are going to purchase treasury bill from commercial bank. Okay, so I'm going to explain to you why they don't buy treasury bill from Treasury Department directly. Okay, let's take that as given and see how things are going to go. So the Federal Reserve, if they buy some treasury bill from the commercial bank, now look at how the account is going to change. For Federal Reserve, their treasury bill will increase by 100 million. And for the commercial bank, so their treasury bill will decrease by 100 million. But how the Federal Reserve is going to pay for commercial bank? So actually, so they are going to pay, this is like quote unquote, it's not literally pay, essentially they just change or make some change to commercial bank's account in central bank. So what they're going to do is they're going to add some reserve in commercial bank's account in the central bank. Okay? And then, so if we look at the Federal Reserve or if we look at the central bank, you're going to see, so the central bank has additional $100 million of liability. So this $100 million liability corresponds to the increase in reserve of the commercial bank. And why the commercial bank has increase in reserve is because, so the commercial bank sold $100 million of treasury bill to the Federal Reserve. As a return, the central bank give the commercial bank a certificate says, so you have additional 100 million of deposit. But in this case, actually we call it reserve in central bank. Right? But now remember earlier we talked about excess reserve. No commercial bank will hold additional excess reserve because that makes zero profit or very little profit. And then what the commercial bank is going to do, because they have additional 100 million of reserve. So instead of just keep this reserve in the Federal Reserve Bank, or the central bank, so they are going to make loans out of this $100 million of reserve. And then when they start to make loans based on this $100 million of reserve, the multiplier we talked about at the beginning of today's class will kick in. Or in other words, and then commercial banks start to generate money supply. All right, so let's just replay what we have discussed. Okay? So we start with Federal Reserve buy treasury bill from commercial bank to pay for these 100 millions of treasury bill purchase. So the Federal Reserve Bank is going to give 100 millions of reserve to the commercial bank. For the commercial bank, they break even, right? Because I sold 100 millions treasury bill, and then so I have additional 100 millions in the central bank. All right. So you can see, so for the commercial bank, so it's break even. Now with 100 millions additional reserve in central bank, the commercial bank will start to make loans out of this new reserve, and then so you can see the money supply will start to kick in. So there's a question about this process. So does the increase in commercial bank reserve come from printing money? So actually here in this process, the Federal Reserve doesn't need to print additional money, not at all. Okay. So what the Federal Reserve Bank did here, instead of printing money, it just makes some change on their account, right? So it literally, the Federal Reserve Bank buy treasury bill from commercial bank, and then so make change on commercial bank's account in central bank. So that's it. So they don't need print money, but certainly, so the central bank or Federal Reserve can generate money through printing money. Okay, so but that's different. But usually, so in these days, so the central bank, they generate money through this process by purchasing treasury bill from the commercial bank. Right? So this is called open market operation. Now to finish this part, so we can look at the opposite. The central bank, they can sell treasury bill. So now their treasury bill decrease. And then the commercial bank, whoever purchased this treasury bill, so they have 100 millions of additional treasury bill. How they're going to pay for their treasury bill? So they're going to use their reserve, which is their deposit in central bank, to pay for this treasury bill. Now, the commercial bank will lose some reserve, right? But now remember, so we have a reserve requirement. And then so the commercial bank must tighten their lendings, or they need to add additional reserve to make up this loss, to satisfy the regulation. And then immediately you can see, so the commercial bank will reduce money supply, right? So basically what they can do, there are two ways. One is they are going to record some loans. But usually what they're going to do is, so for new deposit, they stop to make new loans so that they can make up this shortfall in reserve. But in either case, you can see this open market sales of treasury bill will reduce money supply, right? Okay, so one more thing to discuss regarding this part is why the Federal Reserve purchase treasury bill or sell treasury bill to commercial bank, not doing business with Treasury Department directly. This is because if Federal Reserve buy or sell treasury bill with Treasury Department, that is equivalent the Federal Reserve buy and sell treasury bill with the government. And furthermore, that is equivalent the Federal Reserve printing out money and the money handed to the government. And what is the problem with that? That's going to create some unnecessary inflation risk, right? If this is how the money supply is created, and then so whenever the Treasury Department or whenever the government, like the president, needs finance a big government project, and then they can issue some treasury bill and then ask Federal Reserve Bank to buy this treasury bill. So that is going to artificially create inflation. Also, that's going to create unnecessary price fluctuation. But now, instead, if the Federal Reserve Bank cannot buy or sell treasury bill or do business with Treasury Department directly, it must work through commercial bank. So that is going to put some restriction, or that's going to put some discipline over the central bank. Because the central bank, they must sell their bond to a commercial bank. But the commercial bank, they are not subject to the government's will, right? So I may not want to buy your treasury bill. So that gives you some pressure. I mean, give the Treasury Department and particularly the central government some pressure to discipline their fiscal policy. Or in other words, so the way it's operating now, give the Federal Reserve some independence. Okay, so that's very important. So that just make sure so we can maintain some price stability, right? So let's just take a break and then we continue our discussion.